Hey Jeff, it's Tim Key. Tim Key. This is a video just for you. I'm gonna clear these drawings and I'm gonna answer your question. Where are you? I'm tired, man. Asher was waking a lot in the night time last night. So anyways, you asked, can you look or can you see historically what's happened over earnings? You can. Come up here to this tab once you're in Auction House, Home Depot. Come up here to this tab, hit earnings. Now, mind you, it's going to give you like these kind of double earnings. I'm not, honestly, I don't know exactly what that is. What I do know is that normally the bigger moved ones like this is the actual earnings date, or this gap up and then move down is the actual earnings date, or this one how it gapped so hard, actual earnings date, whereas this one didn't even gap at all. Over here, let's look. There's only one here, so you know that's it. There's only one here, so you know that's it. These other ones might be, oh gosh, whew, excuse me, that scared me. These other ones here might be dividend dates. Anyways, so once you find it, it's the big one of the two, and then you can just go 3 months out, 3 months out, 3 months out. So this is what you do. Look at it, find your previous date. You can see down at the bottom of the screen, down here-ish, there's a date. It's 8/15, or you can just click on this thing, and it'll give you a date. To get rid of that, you just click on it again. So once I do that, I'm looking at the price movement here, but I don't see implied volatility here. So that's when I go over to Think or Swim, and we're going to do an analyze. And you do the think back, and you come to Home Depot, type in your Home Depot ticker, and then you want to find this date, at least a day before 8/15. So we're going to come up here to this little calendar. Oh, we're in the 16th year. Let's come back here. 8/15 is that day, so we're going to come here. Boop. And we're going to see over here on this side is the implied volatility. Yes, implied volatility historically. And if you can't see that, that's a good open interest maybe. I'm trying to find out if you can't see that, because sometimes you can't. Oh, here it is. So if you can't see this open this implied volatility over here, come up here to this layout and hit customize, and that's not showing it either. I just believe that this auto populated. If it's not, maybe search around in here and find it and put it on there. And so you can click that. So let's go and put like we did an iron butterfly in this thing. I'm so sorry, Jeffrey. Yeah, I don't think your name is Jeffrey, but I called you Jeffrey. So let's do a think back test an iron butterfly as if we were doing it here. So we're gonna look at we're gonna find the expected move. So to do that, you see the last is 154, so the closest is going to be 155, so 210. Let's get a calculator. Calculate it. Okay. If it wants to work. It is like, you see that? It's tweaking out on me, man. All right, 210 plus this price over here, which is $3. 300. It's 510. We're going to find the 70% of that. 357. Divide it by 154. You don't have to do coins, pennies, or whatever, but you can. That's a 2.3 expected move, so we can say we expect this to go as high as 157, or as low as 354 minus 154, or as low as 150. So 157, 150 is our break-even, our expected move of earnings. So to act like we're putting on an iron butterfly, which is what we're doing, we're just going to hit the bid on both the call and the ask of the closest at the strike money, and then we're going to go pretty far out, about 10 strikes out. My brain is not working, I'm telling you. I need a spark, that's what I need. And then over here, it won't do the math for you, which is kind of bummer. So the red ones represent the credit you received, the green ones represent the debit. So let's just do a little calculating. Where are you, calculator? So we'll say it's 475 minus 32. So this brought in a 443 credit So that means that this thing can move as high as 159.50 and as low as what's 155 minus 155 minus 4.3, the credit we received. So it can go as low as 150, which is right at what we think it's going to do. And then you just do this. You hit next day, boom, and see what happens. In this case, it looks like, okay, so that's a hard thing too. So it looks like currently that this, it would have been a losing trade, but let's go look at the stock of it. Look, it opened up here and came all the way down here, and what it does, Thinkorswim will evaluate close to close prices. So it's not going to evaluate, it's going to evaluate from the 14th, whenever we open the trade, close price, to the 15th close price. But we know if we were awake with the market that we could have gotten out of this trade maybe up here. So let's just chart it. Where are you? Horizontal. We're gonna just kind of act like we're charting this. We got in at the 155 as if we were in this trade. We got in at the 155. I'll make sure it's a big chubby line. 155. Boom. Okay. There we go. 155. And then we went out long 10 strikes out from that, so all the way up to the 165, which is way up here, and then the 145, which is way down here. We took in a $430 credit or somewhere around there. So that means we could go as our break-even points are way up here at 155 plus 4.3 equals 159.30. Yeah, I'm not amazing at math. I just use calculators. I leverage systems. Haha. And then 155 minus 4.30 is 150 and 70 cents. Come on, 150 and 70 cents. Close enough. Boom. So this is what the trade would have looked like. We would have gotten in here at an iron butterfly on this date, the 14th. Had a ton of implied volatility, had 37% close roughly, and then it would have opened in the market right here, and we know that in an iron butterfly our max profit is achieved whenever the price of the underlying stock is closest to the short positions, which in this case is 155. So what would have happened was this thing would have opened and it would have dropped against us and against us and against us and against us and against us, and at some point we would have adjusted our order and Bink got out and said, okay, 15 minutes in the market, this thing's still going against us, let's get out, capture a profit, and we could have gotten out here and then we would have captured all of the profit here. So I hope that makes sense for you. That's a little iron butterfly strategy breakdown. Your question was, can you find, let's clear this, can you find historical implied volatility? You can use your events, earnings, and then go back. They go in 3-month cycles. So this one, you could go back to this date here, 5/16. So you'd come back here and you'd go 5/16, so you'd go to the 15th. It's at a 33% implied volatility, and you could just rinse and repeat that. It's kind of hard to back test it because, as I mentioned, you know, it goes from close to close price, and this thing was going closed, you know, really far against us, but if we opened in the market we could have captured it maybe up here. So I hope this adds value to you.